Okay, let's dive into this. For decades, U.S. Treasury bonds were more than just a safe bet,
Oh, absolutely. They were the standard, the bedrock.
right? The bedrock of global finance,
Right.
the most trusted IOU out there. If you were a nation, a big company, a pension fund, that's where your money felt safest.
It was the anchor, really, for pricing assets, storing value, even for global trade. Felt unshakable.
But things are shifting now, aren't they? The analysis we're looking at describes this quiet storm brewing.
Right in the middle of that massive $27 trillion treasury market, shaking that trust.
Yeah, exactly. So our goal here is to unpack that, to pull out the key insights from the material you sent over. We want to figure out how the U.S. bond market went from being, the symbol of stability.
To potentially the center of a crisis.
Yeah.
We need to connect the dots.
So we'll trace it back. The age of cheap money, how inflation kind of lit the fuse.
The debt burden today, who's buying or maybe not buying anymore.
What the big names are saying, why this time feels different.
And crucially, how it hits home for you, your mortgage, your retirement savings.
Right. And then maybe what could possibly be done about it all.
Okay, so let's set the scene. Remember the age of cheap money? It really kicked off after the 2008 crisis.
Oh yeah, that was a huge moment. The Philly reaction was, well, pretty unprecedented. They cut interest rates basically down to zero.
And critically, they started quantitative easing, QE,
Buying up bonds, the government bonds, mortgage stuff.
on a massive scale. And the point was to push down yields, right?
Yeah.
Make borrowing super cheap for the government.
And Washington definitely took advantage of that. Deficits got bigger.
But nobody seemed too worried initially because the interest payments were so low.
Yeah, the debt-to-GDP number climbed, but didn't feel painful yet.
Then came COVID, and another massive injection, over $5 trillion.
Like putting the economy on life support.
But paid for with essentially a mountain of IOUs. More debt.
It cushioned the blow then, for sure.
Yeah.
But the analysis points to mid-2021 as the turning point. All that money, plus supply chain issues.
And bam! The inflation genie was out of the bottle.
Which led to this violent monetary pivot, as the source calls it.
Violent seems about right. Inflation skyrockets, fastest in 40 years.
And the Fed had to slam the brakes. Hard. Rates went from near zero to over 5.5%.
In less than 18 months. That's incredibly fast.
And that wasn't just tweaking things. The material calls it a tectonic shift for the bond market.
Well, think about it. If new bonds are paying, say, 5%, why would you want an old one paying like less than 1%?
Exactly, so the price of those older bonds just tanked.
And who held loads of them? Banks, pension funds, insurance companies, suddenly facing staggering paper losses.
We saw that play out in real time, didn't we? Silicon Valley Bank, March 2023.
A big part of their collapse was exactly that the value of their bond holdings just evaporated as rates rose.
Second biggest bank failure in U.S. history. Kind of a wake-up call.
And it wasn't just the banks holding old debt. For the government issuing new debt, the cost went through the roof.
That routine job of refinancing, rolling over about $1 trillion each year.
Suddenly became, as the analysis puts it, a recurring nightmare of higher interest bills.
Which brings us straight to this really alarming part. The debt bomb becomes reality.
The numbers are just, wow, over $1 trillion annually.
Just on interest payments. That's more than the defense budget. More than Medicare.
It's a huge chunk of the budget, non-negotiable, and the risks are very real right now.
Like rollover risk? What's that exactly?
It means over 30% of all federal debt comes due in the next 2 to 3 years.
So trillions need to be refinanced soon.
At whatever the market rate is then,
Yeah.
which is likely to still be high. So these high costs get locked in.
And then there's crowding out.
Right. If government bonds have to offer juicy yields to attract buyers.
That pulls money away from other things, like businesses wanting to borrow.
Exactly. Makes it harder and more expensive for private companies to get loans, invest, grow. It can stifle the economy.
And the most obvious thing is just the strain on the budget. That
Yeah.
$1 trillion in interest.
Means less money for everything else. Infrastructure, education, science, you name it.
And the key takeaway from the sources. This isn't some far-off theory. It's happening now. It's baked into the numbers.
And adding to the pressure is this big shift in who's actually buying all this U.S. debt. We're seeing the vanishing foreign buyer.
Yeah, for ages, Countries like China and Japan just bought up treasuries like crazy.
Held trillions combined. It was the safe place for them to park their cash reserves.
But that's changing. China's holdings are down, what, over $300 billion since 2018?
Yeah, a significant drop. And Japan, well, they have their own issues, so they're not the guaranteed buyer they once were.
And the analysis links this to geopolitics, which is interesting.
It does. The idea that the U.S. dollar, the financial system, can be used as a political tool.
Like through sanctions.
Right. That makes some countries pretty nervous about holding too many dollar assets.
And you see them experimenting, right? Brazil, UAE.
Trying to settle trade in other currencies, yuan, rupees, even gold-backed deals sometimes, bypassing the dollar.
So the world is subtly but steadily de-dollarizing, as the material puts it.
A multipolar monetary world might be emerging, slowly, but it's happening.
Okay, so you've got massive supply of debt, you've got key buyers backing away. That's got to shake confidence.
And it has. Investors are definitely getting nervous. You saw it with the credit rating agencies.
Fitch downgraded U.S. debt, August 23, pointed right at fiscal deterioration.
Basically saying Washington can't get its spending under control. And Moody's followed suit earlier this year, called the debt path unsustainable.
That's serious language from those guys. Markets notice.
Oh, yeah. Yields jumped. Suddenly, this risk-free asset
Carried a scarlet letter. That's a strong phrase from the analysis.
And it's not just the rating agencies. Listen to who's sounding the alarm. Jamie Dimon at J.P. Morgan Chase.
What did he say? Something blunt, I bet.
Very blunt. We are walking into a fiscal time bomb.
Wow. And Larry Summers, former Treasury Secretary?
He called it the most reckless peacetime fiscal path in U.S. history.
Okay, that's stark.
And Ray Dalio, founder of Bridgewater, even simpler. The bond market is broken.
So the analysis is really clear here. This isn't just fringe worry. This is the mainstream saying, uh-oh, there's a reckoning coming.
Right. So what makes this situation different? We had the 2008 crash, the pandemic shock. Why is this unique?
Material calls it a structural, self-inflicted crisis.
That's the key. It's not just bad mortgages or a virus. It's deeper problems within the system itself, built up over time.
So what are those core structural forces driving it?
Okay, first, the Fed is kind of stuck. They can't just ride to the rescue like before.
Why not?
Because buying bonds now, after that huge inflation fight, it could just reignite inflation, undermine their main job.
So buyer of last resort. Not so easy this time. Rock in a hard place. What's next?
Second, it's this imbalance. A surplus of supply, but not of trust.
Meaning, the Treasury has to sell trillions in bonds.
But the usual buyers aren't as keen, as we said. So to attract buyers, they have to offer much higher interest rates, which makes the debt problem worse. Vicious cycle.
Okay, number 3.
This one might be the toughest. Political paralysis.
Gridlock, debt ceiling fights.
Exactly. Constant brinksmanship. Talk of huge new spending even now. It just signals to everyone that there's no real plan, no fiscal anchor.
No serious commitment to getting the finances sorted out.
Right. And fourth, looping back to what we discussed earlier, that shifting global financial order.
The dollar's dominance isn't quite what it was. Foreign demand can't be taken for granted.
So those four things together make it a really difficult structural problem.
Now, all this talk of bond yields and global finance, it can feel pretty abstract for most people.
Yeah, like it's happening on another planet.
But the analysis insists this isn't just Wall Street stuff. It's a kitchen table issue.
Absolutely. So how does it actually affect you?
Well, look at mortgages. That jump in Treasury yields, directly linked to average 30-year mortgage rates hitting over 7%.
Highest in 20 years. Makes buying a house way, way more expensive. Or maybe impossible for some.
And small businesses feel it too, right?
Oh, definitely. Higher rates mean loans cost more. Banks get pickier about lending. That makes it tougher for entrepreneurs to start up or expand. The source says it's choking entrepreneurship.
What about retirement? Pensions? 401k?
Well, many pension funds, insurance companies, they hold lots of those long-term Treasury bonds.
The ones whose prices fell.
Exactly. So those funds are looking at staggering losses on paper. Eventually, that can trickle down to the returns you get or the stability of those funds.
And higher bond yields make stocks look less appealing, too.
Yeah, relatively speaking. If you can get a decent, safe return on a bond, why take the risk in the stock market? So money can flow out of stocks, causing more volatility.
And ultimately, that $1 trillion a year in interest payments
Has to come from somewhere. It means down the line, either higher taxes for you or less government spending on services you use, or both.
So yeah, definitely a kitchen table issue.
Okay. Can the U.S. dig itself out of this? Is it possible?
The analysis suggests, yes, it's possible, but it requires serious reforms, things that are politically very difficult.
Like what? What kind of reforms are we talking about?
Well, first, tackling the big entitlement programs, Social Security, Medicare. The source says they're on unsustainable paths. They need modernization. That's a huge driver of future spending.
Politically explosive, though. What else?
A tax code overhaul, looking at closing loopholes, maybe revisiting tax rates
Yeah.
to bring in more revenue.
Also not easy.
Not at all. And then there's just basic spending discipline, both parties. The analysis mentions reining in defense spending and domestic spending. Needs to happen across the board.
So controlling spending, raising revenue, sounds straightforward, but
But it requires political will that seems, well, pretty scarce right now. And underlying all that is the need for restored institutional trust.
meaning global investors need to actually believe the U.S. is serious about fixing its finances. Exactly. They need to see action, not just talk, to feel confident holding U.S. debt long-term again.
And the core message seems to be, these aren't technical problems anymore. They're political and therefore harder problems.
That really sums it up, which underlines why this matters so much globally.
Right, because treasuries aren't just America's debt. They're fundamental to the whole global financial system.
Everything is priced off them. Mortgages in London, pensions in Tokyo, currency reserves in Brazil.
If trust in U.S. debt really wobbles badly, the fallout won't stop at the U.S. border.
Not even close. The metaphor the analysis uses is powerful. It's not a sudden bomb going off.
More like a slow-motion earthquake.
Yeah. Shifting the very ground beneath the financial world, gradually but fundamentally changing things.
Which leaves us, and you listening, with that big question the analysis raises. Can the U.S. actually manage to stabilize these fault lines? Find the political path?
Or are these tremors, these aftershocks, going to reshape global finance for the next generation? That's really something to think about.